Hi, Larry. Thank you
Morning.
for morning. Thank you for joining us on the SHS podcast, where we provide valuable information to business owners and entrepreneurs regarding relevant topics of the day. So, Larry, you're a CPA over at Aronson. Give us some insight. Who you are? How long have you been there?
I am a CPA over at Aronson. I've been here for approximately 20 years. I've been in the accounting profession for, oh my gosh, it's close to 33 years. I'm like a lifer. Hopefully I'll get time off of good behavior. But my focus has been all my career in helping small businesses and individuals on the tax side. And what I do at Aronson, I wear two hats basically. One is in the traditional compliance services of tax preparation and planning for individuals and small businesses. And the other hat I wear is that I run our firm's federal tax controversy practice for helping individuals and businesses that find themselves in a tax mess, whether it's payroll tax, income tax, liens, levies, and any type of IRS situation, we're able to handle and assist our clients.
I think that has become really more relevant today than almost any other time. I mean, basically, what we're going to talk about today is Biden's proposed tax plan and how it pertains to higher income individuals, to business owners, and really the current uncertainty in the business environment right now, and what we need to consider before year end. I mean, let's jump into that. Let's give us some insight as a CPA into what's going on right now.
So the focus of Biden's tax plan is a tax increase on those with more than $400,000 of income. And about 95% of taxpayers fall under that threshold. So the vast majority of Americans are not really going to see any tax increase specific to the Biden plan. There are overall increases built in under the prior plan that Trump had passed back in that started in 2018 that has certain provisions sunsetting, but Biden's plan itself does not call for any tax increases to those making under 400,000. So what we're talking about really is that the major effects of this are going to touch 5% of the population. Now, the thing is, the majority of the people who I help, they are the higher income earners, and this is where my efforts are concentrated. So let's dive into the various changes that are up for consideration. The major things is the top.
Is the 400, is that combined family income or is that individual income?
The $400,000 is not clearly defined whether that's going to be adjusted gross income shown on a return, whether you're single, joint, filing separate, head of household, or whether it's taxable income shown on the return. But it is fairly clear that it is going to be tax return based. So we don't know whether he's going to make a distinction between the 400 for a single versus perhaps 500 or 600 for married. But the proposal as it is, it talks about $400,000 without distinction.
Okay. Interesting.
So the major highlights of this for the higher earning individuals is that the top tax rate, which is presently 37%, will go to 39.6%. At present, the 37% rate hits taxable income when it is above $518,000 for single and head of household and $622,000 for joint filers. So where Biden's 39.6% will start, it could start at these same levels back to the $400,000 that he seems to be focused on. The next item is the qualified business income adjustment. So those who have pass-through entities like S corporations and partnerships, as well as sole proprietorships, Schedule C, there is a 20% business deduction. That's that 199A deduction that many people have heard about and are benefiting from. Under current law, businesses that are flow through or sole proprietorships, there is a deduction on the individual return for up to 20% of net business profits. And it is subject to certain phase outs, but what the Biden proposal is talking about is a wholesale phase out for those with income, again, over $400,000. So it's this $400,000 focus. So basically what that would mean is that a higher earning individual who can take advantage of this 20% rate on all of their net business profits, at present, they're paying a maximum rate of 29.6%. Under Biden's proposal, if this is phased out, then your tax rate on the same business income will go up to 39.6%. So there's a 10% jump in the tax should you be subject to the phase out. There is also talk about doing something. So what the proposal is involves the Social Security tax, which presently is on the first $137,700, I believe is the threshold for that tax. And then when you earn more than that, there is no tax anymore. Under Biden's proposal, what he's saying is that we're going to leave the 137.7 and have a break until $400,000, and then over $400,000, this Social Security tax would come back. And that Social Security tax is 6.2% is withheld from an employee's paycheck, and 6.2% of compensation is the matching that the employer does. So it's creating a donut hole to, again, to exempt individuals under $400,000 so as not to increase their overall taxes. For itemized deductions, and this is very much talked about, the itemized deduction issue is at present when you itemize, those itemized deductions are coming directly off of taxable income, and your tax is being calculated on that net taxable income at whatever your marginal rates happens to be. What the proposal says is they want to cap the value of itemized deductions at 28%. So in other words, if you are in the 39.6% bracket, the itemized deductions cannot save you more than 28% tax, which means that you're paying 39.6% on your income, but you're only saving 28% on the allowable itemized deductions. Long-term capital gains. This is another one that's gotten a lot of people up in arms about. Over the history of our tax code, long-term capital gains has received some sort of preferential treatment, where it was the old reduction of the amount that is taxable to the relatively new, when I say new, it's maybe the past 30 years, of some type of preferential rate, which at present goes up to 20%. So somebody in the top tax bracket under current law would pay 20% on their capital gains. Under Biden's proposal, those with income over $1 million, which has not been defined what that means exactly, how that's going to work, but over $1 million, the capital gains rate will go to 39.6%. So the 20% rate is gone, 39.6% for income over $1 million, but the mechanics of that computation are not known. On top of this capital gains tax, there's the existing Affordable Care Act tax. That's the 3.8% tax paid on net investment income. That remains in effect, assuming that it does survive the ongoing Supreme Court case happening as we speak. The retirement plans, which presently, if you contribute into a retirement plan such as a 401k or a SEP, the individual gets a tax deduction at whatever their tax bracket happens to be, which means that an individual presently in a 37% bracket, if they contribute to a 401k, they're going to save 37% of that in taxes. Under this proposal, what Biden is advocating for is, instead of you getting a deduction for this, you will get a refundable tax credit equal to a flat 26% of what's put away. What it basically means is those who are in a tax bracket that is higher than 26%, you're not going to realize the full tax savings of this deduction because it's essentially capped at a value of 26%. But the vast majority of Americans who are under that tax bracket, they're actually going to get a refund. It's basically, it's a wealth transfer. In many of these tax provisions, it's more like the greatest wealth transfer in history to try to benefit those that are earning less or substantially less than the $400,000. The electric vehicles, there's a credit for that of $7,500, and it's phased out based on the number of cars the manufacturer makes. So, for instance, I believe Tesla is fully phased out, but there's other electric cars where you can still get it. The proposal is to eliminate the phase out, which means the $7,500 credit would be available on any electric vehicle, presuming it meets the power output. However, unlike present law, the $7,500 credit would be limited to those with income of $250,000 or less. So in other words, somebody making $500,000, you buy an electric car, there's no credit. There is brand new a renter's credit, which would hold rent and utility payments at a combined 30% of monthly income. How this will work, we're not sure yet. There's also no mention as to whether this is going to be phased out for higher income earners, but I'm willing to bet that it would be. Finally, another very major thing is the like-kind exchange, which is under Section 1031. Basically, what you are able to do prior to the Tax Reform Act is that any asset that was used for business or for investment, you were allowed to roll that asset. And we're talking about tangible assets like a car, a boat, a truck, a piece of land, not intangibles like stocks, bonds, et cetera. Those have never been eligible. But a tangible asset that you sell, that you have a gain on, you were allowed to roll that asset gain into the new asset purchase and defer the tax. The recent Tax Reform Act did away with like-kind exchanges for everything except real estate. And what Biden's proposal will do is do away with the 1031 recognition altogether. So this year, if not next year, may be a really good time to take a look at your real estate holdings if you are holding property for investment or for rent, to determine whether or not you want to unwind that into a 1031 to defer the gain while that deferring possibility still exists. It is, I tell you, it is really difficult to plan when there's so much uncertainty. On one hand, planning needs to be done by the year end, but on the other, you have this Georgia senatorial runoff, which is going to be the determining factor as to whether Biden's plan has a shot at passing. The issue is that we don't know until January. So we're, individuals, most businesses are cash basis taxpayers. If you don't do things by the end of December, after December 31st passes, that's it. You can't spend money in January and deduct it in December. You can't do a like-kind exchange next year and try to make it effective this year. So because of that, it is very difficult to plan. But the one thing we do know is that taxes aren't getting any lower. I think it's safe to say that. The government has dug itself into a major financial hole due to COVID with economic stimulus and whatnot. And at the end of the day, it's really us taxpayers that have to pay for it all. And the only way that's going to happen is government has to raise taxes. It has to get revenue from somewhere. So 2020 may be a good year. You have a couple months left, or really a month and a half, I believe, left in 2020, that this may be a good year to hedge your bets and possibly pull more income into 2020. At worst, you'll lose the opportunity cost of the dollars that you had to spend in tax. But at best, if Biden's plan passes next year, which could happen if senatorial runoff in Georgia goes Democrat, then you could potentially save yourself a lot of tax. So that is really it in a quick, high-level nutshell as to what's going on for the higher earners.
So if I can sort of delve into two of the topics that you mentioned, and one of these is actually a kind of an interesting question, but if you, based on everything that you educated us on here, is there a specific income, right? Let's call it a household income because we don't know whether it's individual or whether it's going to be per the tax return, but is there a specific range that you think is most advantageous, that is going to be able to be the best, or the least taxed, or the most advantageous? It looks like making over $400,000. If you're making $450,000, you're going to be socked a lot harder than if you're making 350,000, right? Is
Right.
there you think that is advantageous?
There isn't yet the magic number, and primarily that's because how these phase outs will work, what the mechanics of these are going to be is unknown, and it's just this vague concept of this $400,000 thing. And is that adjusted gross income? Is it taxable income? Is it taxable income, but with taking into account certain adjustments? Do you need to pull in tax exempt income to add to your taxable income to see whether or not you're over this $400,000 threshold for certain types of phase outs? Unfortunately, there's really no way to tell. My thought, and what I've been advising clients to do, is basically hedge your bets and maybe recognize it if you're typically deferring and engaging in a lot of deferral actions toward year end, such as not sending out bills to avoid collecting your receivables, et cetera. Maybe still pull some of that into 2020 more than you normally would. Pay the tax now. You have to pay it eventually. It's not like you never pay tax on this. It's a matter of when you pay tax on this, right? You can't avoid taxes, can't avoid it. And hedge your bets. Pay some more of the tax now. Next year, the worst that'll happen is that the rates, well, or maybe the best that'll happen is that the tax law won't pass and the rates will be the same. But unfortunately, we don't know. And January, it is absolutely just around the corner. But until we know for sure, we would have already passed 2020, and then it's too late to do anything.
And so, taking that sort of a step further, 401ks. A lot of small businesses will put in and have 401ks, and their employees participate. Sometimes there's a match, sometimes there's a profit sharing at the end. They're putting away, try the maximum they can, right? With 19,500 if they're under 50, 26,000 if they're over 50. Is that still advantageous? Is that going to give them a benefit to their company and to themselves individually, other than just they know they're putting money away for retirement?
It will still give benefits. So you're still going to get, under this plan, a 26% credit. So the value of a $10,000 deduction or contribution is $2,600 tax saved. So you're still going to get that. The things that are unknown, there's many complexities with this. Firstly, with matching contributions, if it's paid at an S corporation level, for instance, and that's factored into the net number that shows as your taxable income from the corp, well, is that somehow carved out and part of that 26% credit, or does that get regular deduction treatment at whatever your bracket happens to be? There's so many things with this that's unknown. The other matter that's unknown is that the plan specifically talks about defined contributions and IRAs. So defined contribution plans are SEPs, 401ks, and 403bs. What the plan doesn't talk about or mention are defined benefit plans, like a cash balance plan, where the contribution can be way, way higher than a 401k could. There is nothing mentioned. It's silent as to whether or not this also comes into the 26% tax. Otherwise, it's going to make these DB plans tremendously more advantageous for high net worth individuals, high earners.
And in terms of investing in a Roth, right, or a traditional IRA, or traditional 401k, a Roth 401k, or a traditional 401k. Any advice regarding that? Better to pay the tax now or pay the tax later when you retire?
We've actually done a number of analyses on this very thing, because there's really a push-pull here. So on one hand, if you contribute to a Roth, whether it's a Roth IRA or Roth 401k, you pay the tax essentially on the contribution today because the contribution isn't deductible. But what you're gaining is that the entire growth in earnings come out totally tax-free down the road, which is pretty powerful. But the issue is that if you pay, let's say a top earner, if you don't do this as a deduction and you're paying 39.6% tax as a result of not getting the deduction, or really 26% tax in the form of not taking advantage of this credit, then is the opportunity cost of parting with that tax today that in theory you would have invested, would that plus what would be taxable income down the road in a traditional IRA or 401k, would those together be more, less, or equal to what you would have for a Roth, which is totally tax free? And the analyses that I've run indicate that when you make certain assumptions about market return, let's say a 5% market return, then generally it's almost a wash. That whether you deduct it now and save the tax and invest that tax, that's the key thing. It's not saving the tax and then spending it on something. It's saving the tax and investing it in something that will grow. So when you have, in essence, two things that are growing that are taxable compared to one number that's growing that becomes tax-free, generally it works out as a wash. But from a practical matter, I have not really met anyone that actually has the discipline to take the tax savings and actually invest it and not touch it. So my thought, and personally this is what I do, is to the extent that you can max out your Roth contribution, put it in a Roth first, pay the tax now. You can afford to pay the tax now, because down the road when you retire, you don't want to be put in a position of paying tax at that time. You're on a fixed income.
Definitely. Well, I mean, that's absolutely sage advice. And everything that you've mentioned, today is really food for thought. It's amazing how much is in flux, and the I guess the thought that I get from this, really the summary that I get from this is, talk to talk to your CPA, get advice as much as you can, get educated, look at what the potential best case, worst case are so that you're prepared. And that can only be done with a CPA, somebody who has that knowledge, that is keeping up to date, like yourself. So, Larry, I appreciate the time, appreciate the education. I know that our viewers learned a lot and will learn a lot. And I know that if they need to contact you, we'll have that information in our link as well. But Larry at Aronson, I appreciate your help, your knowledge, and sharing that with us today.
Thank you so much, Steve. My pleasure.